Now, every 5 years, India witnesses a spectacle of democracy, the Great Indian General Elections, where over 900 million or 90 crore eligible voters elect representatives to the Lok Sabha, which is the lower house of the parliament. Now, this event, while a democratic pillar, also sends ripples through the Indian financial markets, creating a period of both volatility as well as of opportunities. Now, as the 2024 general elections loom around the corner, a question weighs heavily on the minds of investors. Will the stock market tank if there's a change in the government? Many investors today are understandably apprehensive about the outcome of the Lok Sabha elections this year and how it will impact their portfolios. Now, the uncertainty surrounding political transitions has historically been a source of anxiety for market participants, leading to fluctuations in the stock prices and heightened volatility as well. Now, in this context, it becomes imperative to delve deeper into the relationship between the Indian elections and the financial markets to better understand the potential implications for investors. We're going to do just that in this episode. You're watching Informed Investor, the Third Umpire, an initiative by Research and Ranking. Let's begin. Now, the stock markets are generally volatile and are largely affected by the local as well as global happenings. Now, the same holds true for elections. An election is a major event in any country that decides the future direction of its economic, social, as well as the political growth. Guess what? More than 80 nations and territories representing over half the world's population are scheduled to go for elections in this year alone. Now, these include big names like the US, UK, European Union, amongst the others. Now, with the conclusion of the state assembly elections in a few countries already in this year of 2024, we now await India's general elections, which are scheduled in the period of April to May. Now, as we know, the Indian stock markets are susceptible to an election fever and experience greater volatility during this period. While we look at the effect of elections on the Indian markets, let's first understand how India's parliament is structured and how its elections process works. Now, the Indian Parliament is a two-tier legislature consisting of the Rajya Sabha, also known as the Council of States, or the upper house of the Parliament, and the Lok Sabha, also known as the House of the People, or the lower house of the Parliament. Now, the Rajya Sabha consists of 250 members, 238 of which the legislatures of Indian states, the subnational regions, and the union territories elect, and 12 of which the president directly appoints. Now, the Lok Sabha consists of 543 members, with each member representing a single voting district. The 2024 general elections will occur to fill these 543 seats in the first past the post manner, whereby voters in each district will cast their vote for who they wish to represent their district, and the candidate with the majority of the votes wins that district's parliamentary seat. Now, to form a majority, a party or a group of parties, which is an alliance or a coalition, must win at least 272 seats, which is above the 50% mark. How have the elections impacted the Indian stock markets? Well, changes in governments or political parties can cause changes in government policies, economic priorities, and regulations affecting various sectors and companies together. While elections create short-term volatility, the long-term effects are mostly shaped by the economic reforms and policies implemented by the new ruling party or the existing ruling party, which continues to stay in power. Moving on, let's look at how the stock markets have performed over the years and how different governments have had an impact on the market collectively. An interesting fact is between 1980 and 2023, India's government changed 11 times, with 8 being coalitions. Now, the media uses tags such as socialist, reformative, business-friendly, etc. to describe the political ideologies or stances of different governments. However, this has very little relevance in the stock market. Now, the best performance of the stock market came during the Janata Dal rule of Mr. VP Singh. The index returned a whopping 100% during the 11-month period. This was mostly due to the pro-market reforms taken by the government. During this period, SEBI was set up, capital goods restrictions were eased, reforms in trade policy and financial sectors were also introduced. This led to a massive jump in the stock markets. Now, in the year 1991, the market witnessed instability following PM Rajiv Gandhi's assassination. However, under PM PV Narasimha Rao ji, economic liberalization policies were introduced bolstering market confidence and initiating economic recovery and growth. Now, it was under this regime that economic reforms took a massive jump, and this resulted in the stock markets rising by about 22%. Now, the period between 1996 and 1998 saw political unrest and external economic pressures affecting the market. Frequent changes in leadership and the Asian financial crisis led to reduced market confidence and an economic downturn as well. Now, the Indian governments, despite being differentiated by the so-called different political ideologies, have stuck to business continuity and even with some policies. If divestment was started by the Congress, NDA continued it. If original insurance sector reforms were started by the NDA regime of Vajpayee ji, it was continued by Manmohan Singh's UPA and further carried forward by the second NDA term led by Narendra Modi. Aadhaar was introduced in the UPA era and it was enhanced further by the NDA. Now, since 2014, the BJP under the rule of Prime Minister Narendra Modi ji has held sway over the Indian government, be it demonetization or the GST that promised one nation, one tax. Some reforms did leave room for debate. However, in recent years, India has emerged to be the economic powerhouse, riding on key reforms and battling through the vices of a historic pandemic. Now, several notable reforms have been made, like the PLI scheme, the Insolvency and Bankruptcy Code, and the Make in India movement, which has attracted FDIs, which has propelled the nation to become the fifth largest economy in the world currently. Now, coming to the current scenario, since 2014, the Bharatiya Janata Party has been in power in India, wielding considerable influence over the government. However, the opposition, after facing defeat in 2 consecutive electoral battles in parliament, appears to be making some changes. Now, in a noteworthy move, in the month of July last year, more than 24 opposition parties came together to announce the formation of a new coalition called the Indian National Development Inclusive Alliance, abbreviated as India. Now, this alliance is quite diverse, encompassing a spectrum of political entities from the Pan-India Congress Party to regional forces like the Dravida Munnetra Kazhagam from Tamil Nadu and various communist parties as well. Now, what's intriguing is how the stock market responds to the current political dynamics in India. Let's delve into the insights provided by top research firms. Jefferies, a prominent research firm, anticipates a potential correction of up to 25% of the Indian stock market if the ruling party suffers an unexpected defeat. Morgan Stanley, another renowned research entity, has outlined 4 possible scenarios for the 2024 Indian general elections, each with its own potential impact on the market, ranging from a modest 5% rise to a significant 40% decline. Let's walk through these scenarios together. The first scenario, in the event that the current government secures a victory with over 260 seats or an absolute majority, it is anticipated that the Sensex and the stock market index may witness a moderate gain ranging between 0 to 5% in the 3 months following the elections. In the second scenario, however, if the leading party, the BJP, falls short of securing 240 seats and it is compelled to form a coalition government, the market sentiment might not be as favorable. In such a scenario, we could see a decline in the Indian markets by approximately 5 to 7%. Now, in the third scenario, if the leading party manages to secure only around 225 seats and assumes control of the government, but another party wields significant influence in the legislature, there might be a substantial drop in the stock markets of up to 20 to 25%, which is primarily driven by concerns regarding political stability and foreign sentiments along with investments. In the last scenario, which is the worst case scenario where the incumbent government loses and the leading party secures fewer than 200 seats, resulting in a weak coalition with limited power, the stock market could experience a severe crash of about 40%. Such a scenario would have deeply unsettling impact on the investors as well as the market participants. Nevertheless, current polls indicate a resurgence of Prime Minister Narendra Modi's popularity, likely ensuring his return to office in the upcoming elections. Now, the results of the December 3 state polls provided a big boost to the Bharatiya Janata Party. The party swept elections in the states of Chhattisgarh, Madhya Pradesh and Rajasthan. The lone victory for the opposition, the Indian National Congress, also known as the Congress Party, came only in Telangana. Now, these results confirm what is already known and what is enough knowledge, common knowledge. As far as the 2024 parliamentary elections are concerned, the BJP remains firmly in pole position. Now, let's talk about the unpredictability surrounding the growth trajectory of the economy and stock markets under a weak coalition government. first is the political uncertainty. In a weak coalition government where multiple parties with differing ideologies and priorities are involved in a coalition, there may be challenges in implementing cohesive economic policies, which can lead to uncertainty amongst investors and businesses about the direction of the economic reforms, regulatory changes, and the fiscal policies collectively. Now, without a clear and united vision, it becomes difficult to predict the government's actions and their impact on the larger economy. Policy paralysis. A weak coalition government may struggle to push through important economic reforms and policy decisions due to internal disagreements and the need to compromise with the coalition partners. This can result in policy paralysis where necessary reforms are delayed or watered down, hindering the economic ability to address structural challenges and capitalize on growth opportunities. Credit rating concerns. Persistent political instability and policy uncertainty can raise concerns about the credit rating agencies about the government's ability to manage the fiscal deficits, the debt levels, and the economic risks collectively. This may result in downward revisions of the sovereign credit ratings, leading to higher borrowing costs for the government and businesses, further dampening economic growth prospects. It also leads to erosion of the investor confidence. All of these factors can erode investor confidence. Investors may adopt a cautious approach, delaying investment decisions and capital expenditure until there is greater clarity and stability in the political landscape. Now, this can hinder economic growth by limiting investments, job creation, and business expansion as well. Let's delve into why stability is highly valued by the financial markets. First is the predictability. Stability in the political landscape allows investors to make more accurate forecasts about the future economic conditions, government policies, and market trends. Now, this predictability enables investors to make informed investment decisions, reducing the level of risk associated with their investments. Reduced uncertainty. Uncertainty is one of the biggest enemies of financial markets. When political stability prevails, uncertainties related to potential policy changes, government instability, or social unrest are minimized. As a result, investors feel more confident about the stability of their investments and are more willing to commit capital to the market. A stable government environment fosters confidence amongst investors and businesses alike. When investors have faith in the government's ability to maintain stability and promote economic growth, they are more likely to invest in stocks and other financial assets. Similarly, businesses are more inclined to make long-term investments, expand operations, and create jobs in a stable political climate. Attractiveness to the foreign investors. Now, political stability makes a country more attractive to foreign investors. International investors prefer to allocate their capital to countries with stable political systems and favorable investment climates. Consequently, stable political environments often attract higher levels of foreign investment, which can contribute to the growth and the development of the domestic stock markets. Overall, we need to focus on the three building blocks that would lead to robust stock market returns. A political system that encourages private enterprise, an ecosystem where entrepreneurship is encouraged and where it thrives as well. Third, a promise of long-term economic growth along with corporate profitability. We should be proud because India is a country that is blessed with all of the above. Now, during such precious times, all we need to do is invest and stay invested. Coming to the last segment and some key takeaways for the investors as an investor here and some crucial points to consider during this election season. First is to stay informed, follow reliable news sources and track the progress of the elections and campaign promises of major parties. Second, diversify your portfolio. Don't base your investment decisions solely on election-related uncertainties. Spread your investments across different asset classes and sectors to mitigate your risk. Third is focus on the long term. Don't react or overreact to short-term market fluctuations. Maintain a long-term investment horizon and stick to your investments and to strategies as well. Fourth is to seek professional advice. Now, if you're unsure about navigating the market during elections, consider consulting a qualified financial professional who can guide you based on your individual risk profile and the investment goals. Now, to conclude, the Indian markets have been fairly resilient in one of the most challenging times if one excludes the once-in-a-century pandemic years. Now, do know that the Indian stock markets hit record highs through the most aggressive campaign of interest rate hikes by the Federal Reserve, as well as an intense campaign of tightening of the monetary policy by the Reserve Bank of India as well. Now, in conclusion, by staying informed, diversifying your portfolio, and focusing on the long term, investors can navigate any period of uncertainty and make informed investment decisions for a secure financial future. With that, this is Raj Mehta signing off, wishing you and your loved ones the very best. Take care and stay invested.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.